Well, hello, I'm Tatiana Paterno, a partner at Badfair and Sims in Nashville. For those of you who are not familiar, we are a full-service law firm with close to 300 attorneys. Our healthcare private equity team has advised on over 150 transactions over the last 2 years, mostly in the middle market. And most recently, we ranked as the third largest healthcare law firm in the country, and we were named Healthcare Practice of the Year by Law 360. It is my pleasure to welcome you to the first joint event with ACG chapters from San Diego, Texas, and Tennessee. Thank you for joining us today as we discuss 2021 healthcare M&A perspectives across the nation. We will have 2 panels, an investment bank panel and a private equity panel, which I'll introduce in just a minute. After the panels, we will have a Q&A session, followed by 2 short networking sessions. We ask that you please submit your questions through the chat box so we can address them during the Q&A session. We will be recording the program today, but not the networking portion. We'll be sending out an email with the link when it's ready, so you can, if you'd like to share it with your colleagues. To optimize your Zoom experience today, we recommend that you adjust your view. In the upper right-hand corner, you can select speaker view to follow the active speaker or remain in the gallery view to see everyone. Also, while we are displaying the slides, you can hover your cursor over the center of the screen to toggle the split screen and adjust the proportion of the slide and the speakers. As you can imagine, much went into coordinating this program. So I would like to recognize committee members who helped put this program together. Our 5 chapters work collaboratively to assemble today's panel of experts, handle logistics, and all the details. Thank you all. Before we begin the program, I would also like to recognize the companies who serve as sponsors for our various chapters. Thank you to these firms who are current sponsors for the Austin San Antonio chapter. The Houston chapter is supported by these sponsors. Companies sponsoring the Dallas-Fort Worth chapter. Here they are. Thank you. The San Diego chapter is supported by these sponsors. It's a lot of them. That's wonderful. And finally, let's see. These are the firms that sponsor the Tennessee chapter. Thank you to all sponsors who continue to support ACG. At this time, I would like to introduce the investment bank panel. Dr. David Crean is a registered investment banker and managing director at Objective Capital Partners in San Diego. He leads the firm's M&A, partnering, valuations, capital financing, and strategic advisory transactions with life sciences and healthcare companies. Dr. Crean currently serves on the board of directors of Histogen Inc., a NASDAQ company, and the California Life Sciences Association. He's current president of the Association for Corporate Growth, San Diego. Next, we have Becky Gregg, who is the director at Brentwood Capital Advisors, a middle market investment bank that provides M&A and capital raising advisory services for healthcare, technology, and tech-enabled services companies. Becky has been at Brentwood Capital for 10 years. Prior to joining Brentwood Capital, she worked as an analyst in the debt capital markets group of Bank of America Merrill Lynch. Becky lives in Houston, Texas. Next, we have Mike Malloy, who is a vice president in the Raymond James Healthcare Investment Banking Group. Prior to joining Raymond James, Mike served as an associate at Ferris Capital Group, a middle market private equity firm focused on healthcare services investments. Mike is based in Nashville, Tennessee. And now I would like to introduce Kayla Marsh, who will be moderating today's panel. Kayla is based in Dallas, Texas, and she's with BKD LLP. That is a full-service accounting firm. Kayla serves as ACG YP Committee Chair and is also on the Board of Directors of ACG DFW. She provides audit services to healthcare providers, including private equity-backed healthcare entities, physician practice management entities, nursing facilities, hospitals, and health systems. And her technical knowledge includes auditing and assisting with complex corporate structures, acquisitions and mergers, and reimbursement complexities faced by healthcare companies. Kayla, now to you.
Thanks, Tatiana. I appreciate the introduction. I'm very excited to be here. Even in the virtual, it's not exactly what we expected a year ago from today, but it's not very often that we're able to get such experts in the healthcare market from literally across the country. As our committee came together and planned this panel, we were really set and focused on let's bring in perspectives from across the country. And not only just from across the country perspectives, but also in different facets of healthcare. Healthcare is not one-dimensional. It's not just a hospital. It's not just a physician clinic. There's so much more to it. And so my thought with the panel is we're going to go kind of from a supply to a demand approach. So first with supply, I've got our bankers here. I wanted to take a few minutes to discuss activity and a few of the sub-industries that they work in. So to lead it off, Becky, at Brentwood, I hear that you guys have quite a bit of deals in the healthcare tech space and even some that just recently closed. So can you tell us a little bit about what all does the healthcare tech entail and how deal activity has been through 2020? Any pitfalls or lessons on recent deals closed?
Sure, definitely. First off, thank you, Kayla, and thank you for including me in this discussion. It's definitely an interesting time to be talking about M&A activity in the healthcare space. I think when you look at M&A activity in general and healthcare specifically, there definitely was a lack of activity in Q2, really quiet as the pandemic hit, just as you would expect across other industries. We saw an increase and a tick up in deals by the end of the summer, which really accelerated in the fall with Q4 being extremely busy, especially in that healthcare tech space. I think Q4 was probably the busiest Q4 I've seen in the 10 years that I've been at Brentwood Capital. I think when you look at healthcare tech, there were already trends driving demand and driving opportunities within that space. Hospitals, healthcare systems across the board are looking for more efficient ways to operate. They're looking for those outsourcing opportunities. I think there are different healthcare tech companies that have been impacted differently by the pandemic and therefore impacted deal activity within 2020. When you look at some of your more tech-enabled type of companies, those RCM companies, especially companies that maybe have some variability based on hospital claims, those companies definitely saw more uncertainty and had a little bit more work to do to get a transaction done in 2020. I think that being said, there's still deals to get done in that space. We closed a transaction where we represented a company called RSource that received an investment from Sunstone Partners. I think the more interesting part of healthcare tech and where we're seeing a lot of activity is really on those SaaS platforms. So those companies that have that subscription recurring revenue base and are able to have that stability even when healthcare as a whole was going through a little bit of uncertainty given the pandemic. I think when you look at those SaaS type of companies, some of the areas we're seeing a lot of activity are, analytics, anything that can help with outsourcing and efficiency. Obviously telehealth has been a big buzzword all through 2020, being able to deliver healthcare to individuals regardless of the setting and how that's able to assist on the healthcare services side has been big. Another big theme has been patient engagement. As you get that transition to consumerism across the healthcare industry, having those technology platforms that can assist with patient engagement have been really a big hit. We helped close a transaction for a company called HealthX, focused on that patient engagement side. This company was acquired by Tomo Bravo in conjunction with their acquisition of Zapari to form a consolidated platform to address patient engagement from a payer perspective. So not just on the provider side, but also looking at it from the payer side as well. So a lot of interesting things in healthcare tech. As I said, we've been very busy, especially in Q4, and we expect that trend to continue into the new year.
I think all of us can say we wouldn't have survived without technology for the past year. So the fact that it impacts healthcare is even more extensive. So thanks, Becky. To shift over to another sub-industry, so the healthcare services. Mike, now at Raymond James, I know you guys have seen a lot of activity in the healthcare services space. Can you speak to the type of deals that you're seeing? So those that are actually touching the patient, or those that are there to support the companies that are touching this patient? Any, with stay-at-home orders, how has that impacted the space?
Thanks, Kayla. Really excited to be here. Good afternoon, everybody. I work in the Raymond James Healthcare Investment Banking Group. I focus all of my time on healthcare services companies. There's about 15 of us who split the market up, focused on post-acute home health and hospice, behavioral health, physician practice management, and specialty pharmacy and distribution. So I think for the most part, we would define healthcare services as really any patient and provider interaction. And these are business models that are going to involve a fair bit of complexity around reimbursement. You've got commercial payers, you've got government payers, Medicare, Medicaid. They're not all created the same. And so the businesses have to navigate different revenue streams. There's also a significant amount of regulatory requirements and burdens placed upon these companies that can really differ state to state, geography to geography. So it's a rapidly changing, it's a complex environment. And then you throw COVID on top of it, it made for a real challenge in Q2, Q3. So across all the sectors we work in, we saw slowdown during that time, as Becky mentioned. I think we had a really similar experience on the services side. But once business operators and private equity firms were really able to take stock of what was going on and react to the initial shock of COVID, we saw activity begin to pick up in Q3 and into Q4 and had a really busy Q4. I think part of that is Labor Day is just a natural launch window for any M&A transaction. We're pushing our buyers to give credit for full year results. As you enter Q4, you have more visibility on full year. So we always like to launch deals around Labor Day. And in 2020, we were working with companies that had paused processes at the beginning of the year and companies that had intended to go to market kind of mid-year, but had to push to the end of the year. So there was a bit of a backlog that developed in Q4 that hit the market at the same time. And so everyone we talked to in the M&A space was really busy. But I think as you dig down a level deeper, the activity you saw was different across different subsectors, really depending on how they were impacted by COVID. Certain sectors like home health and hospice that really benefited from a lot of the macro COVID trends of getting people out of hospitals, getting people into lower cost of care settings. These businesses performed well during COVID and actually had some really good results from an M&A perspective. We worked with a company called Mission Healthcare on the West Coast, and we're able to launch a process during COVID, close a process during COVID, worked with a lot of private equity investors over Zoom. We're able to schedule socially distant in-person meetings late in the process. So that added a bit of complexity there. But all in all, was a really good outcome for a business that was not impacted significantly by COVID. Behavioral health is an area of interest. There's a lot of subsectors within behavioral health. I think the residential providers were impacted by COVID, but the outpatient providers and anything that can touch telehealth or telepsych actually benefited from a lot of the change overnight due to COVID. These are businesses that have been able to trade during 2020. Physician practice management is an area where we saw a lot of impact on the negative side. It's hard to go to the dentist over Zoom. It's hard to go to some specialist over a telehealth model. So these are businesses that had a tough Q2, Q3, but were able to work through that. And I think are really looking to 2021 as a year for growth, as a way to bounce back and think about M&A. So all in all, a bit of a mixed bag really across the various subsectors we work in, but certainly pockets of really attractive activity.
Yeah, so you mentioned Mission Health. We'll be talking about that a little bit later.
Yeah.
It sounds like on the healthcare services side, it's a peak followed by a valley followed by a steep peak. So it'll be exciting to see. Now, David, I did a little research and noticed that Objective Capital Partners was named Healthcare and Life Sciences Investment Bank of the Year by Global Health and Pharma. Now, life science is a whole nother beast in itself. In connection with that, can you walk us through what really encompasses the type of deals you're seeing in life sciences right now, and what really is the difference as compared to deals in services or IT?
Thanks so much, Kayla, and great to be with everybody. And I think Becky and Mike provided a really great overview of what's going on in the healthcare technology and healthcare services side. But as you mentioned, and you certainly noted, life sciences is kind of a different beast. I think there's a different investor base, if you will. It's not for all PEs because there's a tremendous amount of risk and high reward. It's not your predictable cash flow model. But you'll find some PEs. I see it more as a VC play or a corporate venture capital play, maybe some family offices if they can get comfortable with that space. Certainly on the strategic side, it's an absolute, love fest, if you will. This is typically your pharma, your biotech, long development times, heavily regulated by the FDA as well as other regulatory agencies. There's third-party payers involved. Mike just talked about those. It's not only about if you can create a safe and effective medicine, but who the hell is going to pay for it? So it's a different beast than talking about healthcare services, meaning I'm selling something to pharma or biotech or academic or government labs. This is about, developing small molecules or biologics, even the vaccines. That's kind of a really classic space, what I call the life sciences. And I'm really excited about going into 2021. As Becky mentioned, you saw that little drop off, big drop off, about 30-40% in Q2, started picking up just around Labor Day. And then the fourth quarter was just gangbusters. 2021 is going to be no different. It's just right now it's on fire. Several of the largest M&A transactions that occurred in 2020 occurred in the pharma space, where deal making really is now approaching pre-pandemic levels. And over the past decade, what we typically see is these large pharma or large biotech companies scale back their own R&D activity in favor of making acquisitions of companies, smaller or mid-sized companies who are at clinical trial stage. I like to call it M&A as a new R&D. And this strategy really mitigates the risk for the acquirers while injecting liquidity in the market for these smaller companies. And what I see is the pandemic in 2020 is really just proving to be an accelerant for pharmaceutical M&A. So I'm really, really excited about 2021, and it's just if there's any indication of the last 6 weeks, it's just it's gangbusters. I just came off of a JP Morgan healthcare conference, and there's just tremendous amount of activity and motivation and momentum behind that. So thank you.
Yeah. It's Becky, you alluded to Q4 being one of the busiest times in your career. When you look at those types of investments and the investments that you guys are seeing come to the table, do they seem to be investments where the pegs are building on current platforms or add-ons or full on new platforms? Does it just depend on what it is?
So it's a great question, Kayla. I think, 2020 definitely saw an increasing number of add-on transactions getting completed. I think that trend had already kind of started in 2019 before the pandemic. Just given where healthcare multiples are, you had already seen some private equity firms seeing an efficient way to put capital to work by doing a more buy and build strategy, especially on the services side. I think in 2020, especially over the summer, once several of those private equity firms had shored up their portfolio companies, they saw doing add-on investments as a less risky way to continue to put capital to work before they fully felt like there was stability in the market. I think now, once we got towards the end of the fall and into Q4, there's plenty of stability in the market. We're definitely seeing standalone platforms getting done, especially those higher quality assets. There's tons of pent up demand. So I think you're seeing, you're definitely seeing both getting done, but you definitely had an increased percentage of add-on acquisitions, especially in that summer and the fall time. I think the only other thing I'd note about it is I think when you look at the supply of opportunities for sale, there definitely were some independent standalone either physician practices or other companies that may have gotten spooked by the pandemic and realized they didn't want to do this on their own. And so you had some more opportunities for those smaller companies looking to either be acquired or have a partner that were getting scooped up by private equity firms.
Yeah, for sure. Well, so we talk a little bit about the acquisitions now. Mike, quick, could you kind of tell us what are you seeing from an exit standpoint? Obviously, there was a little bit of a valley and a stall of what it seems. What are you seeing from exits, impacts to timing, multiples, you name it?
Yeah, Kayla, good question. And I think what we saw throughout 2020 and into 21 is A-plus businesses can exit at very attractive valuations. If anything, for really well-run businesses that were not impacted by COVID, valuations might have actually gone up over the past year as more buyers are focused on a smaller number of opportunities. And so it was a seller's market if you were a business that was not impacted by COVID and were able to grow during the pandemic, particularly if you had any part of your business that was able to effectively transition to telehealth. That was really exciting for the next investor. So I think it's been on one end, some businesses have benefited. Obviously, others have had to take more of a wait and see approach. Maybe, as Becky said, focused internally on operational improvements, roll ups, trying to get bigger, and looking to 2021 as maybe the year to transact. I think that's the case. In all of our conversations with private equity firms, I think there's some hesitation around being the first company out in any given sector. You don't want to necessarily be the guinea pig, particularly the back half of the year as COVID cases continue to rise. Now, obviously, with the vaccines coming out, we think there's light at the end of the tunnel. And so I think that actually will spur more activity as people can begin to envision a more normal environment as businesses begin to recover across the services spectrum.
Awesome. So we've got about 4 or 5 minutes till we're shifting over to the private equity group. So, David, thinking being in life sciences and the biopharma space, and especially in the past year with the focus on new vaccine development and lab testing, what new revenue streams are you seeing come to light? And do you think that they're temporary, or is this something that you see as sustainable that's really going to drive value and growth in the long term?
Yeah, I think there's a tremendous amount of different avenues for revenue streams. Certainly, there has been a big focus over the past 10 months just on vaccine development, also therapeutics, going after viral therapeutics as well as diagnostics. For the most part, what I'm seeing is people who are needing to stick to their core, and occasionally you'll find some close adjacencies where companies are taking their technology, their innovation, and going towards maybe trying to treat COVID, either as a therapeutic or as a vaccine, or even on a diagnostic, because it's sort of in a little extension, but they're basically trying to stick to their core, where we're seeing big investments still in oncology, neurology, rare disease. That's still where we see the primary focus. Occasionally you'll see that they're going to that close adjacency, just because, one, there's a lot of money there. There's obviously a definitely a demand across the globe. So that's generally what we're seeing in terms of that revenue stream diversification.
Awesome. So while we're on the topic of revenue, and I knew that we would get to this, and there wouldn't be a way for us to get as many questions in as we wanted to. So if you guys have any specific questions, please shoot them to the Q&A. We've got extra time for that at the end. But while we're on the topic of revenue, let's talk about the thing that's probably the most unique for healthcare, and that's reimbursement. So one of the largest complexities. How have you seen changes or fear of changes in reimbursement impact the deal space, especially of recent? Becky, any thoughts there?
Sure. I mean, understanding reimbursement is obviously a critical aspect of investing in healthcare. You see it across the board. I think it's especially important on the services side. We saw in December, CMS rolled out cuts to a lot of the physician practices in reimbursement back in December, and that hit different specialties in different ways. So understanding the specific impacts and risks there is critical. I think you've also seen legislation come out on surprise billing. That's a topic that's been kicked around Congress for the last year and a half. I think it came out to a place where at least there's less uncertainty around, how those types of ER management companies are going to be reimbursed and how the reimbursement would be impacted in the future. Clearly in healthcare, it's always important to understand the difference between in-network and out-of-network. And if you're looking at an out-of-network provider, what the risk would be to reimbursement as you move in-network over time.
Yeah, that's great. And then lastly, real quick, Mike, governmental funding has been flowing into these healthcare companies. Especially you've got Medicare advance payments, you've got provider relief funds, which are grants that have special reporting requirements, PPP loans, the list goes on. As you're approaching deals right now, how are you seeing those handled? Are they carved out? Are they retained with the seller? Any big last minute thoughts there?
Yeah, we like to treat those almost like a networking capital item. So they always come pretty far down the line in terms of a deal, but any debt stays with the seller as their obligation. They like to keep their cash, but things like payroll tax deferrals need to get trued up before close. So it hasn't been a deal impediment, I would say. It's just made networking capital and some of the last minute negotiations maybe a little bit more involved than they normally are.
Awesome. Well, it goes without saying, you guys have some great insights. I love hearing from across the country, across the industry, and even with the struggles we faced this year, it sounds like there is a lot of pent up demand and a lot of supply there. So with that, I'm going to shift the panel. Thank you all for joining us, and I'm going to shift over to our private equity group. So thanks, guys. We appreciate it.
Thank you.
All right. So it's my pleasure to introduce our panel of experts on the demand side of deals. So our private equity investors. First is Jay Bradford. Jay is a partner of Riata Capital out of Dallas, Texas, and serves on the firm's investment committee and focused on providing operational and financial leadership to the firm's portfolio companies. He has served in various roles for Riata's portfolio companies, including advisor, CFO, and board member. Most recently, Jay served as the interim CFO for Acuity Eye Care Group and as a board member for SmileSource. And next we have Grant Jackson. Grant is the managing general partner of Counsel Capital, a healthcare-focused private equity firm based out of Nashville, Tennessee, which he joined in 2009. Grant has focused entirely on private equity investing in the healthcare services and healthcare IT space since 2001. So he's got great insights. Prior to joining Counsel, Grant led healthcare services and healthcare IT investing for the Aurora Funds and First Analysis Corporation. And last but not least is Nick Lopez. Nick is a principal at HCAP Partners out of San Diego, California, and joined in 2013. Nick serves on the investment committee and is responsible for originating, structuring, closing, and monitoring portfolio investments. He has been instrumental in the firm's investments in 12 companies, many of which achieve fast growth and realize significant value for shareholders and employees. Nick is currently a board member of HCAP Partners portfolio companies, Lone Star Analysis and Diaper, and a board observer for 83 Bar. So thank you all for joining today, and let's jump in and talk about some stories from 2020. So Grant, I understand that Counsel Capital just raised a new fund during COVID. Can you share about that experience and why it was successful? Oh, I think you're on mute, Grant.
Thanks. Pressing mute twice doesn't make you louder. It just keeps you quiet. So thanks for having me on the panel. Excited to be here. Yes, you mentioned the fundraise. Quite frankly, we were not excited about trying to raise money right after the pandemic hit because we had no idea whether we could successfully fundraise through Zoom, just given how relationship-based investing, fundraising really is. It turned out to be great for us because it highlighted how we're different. So because our portfolio performed well during COVID, we were able to show why. And the why was we were picking good industries that could perform well in any market condition because our services, we were looking for really important services. There became a term for that during COVID, and those were defined as essential services. And secondly, we have a value creation team that had supported our management teams in building out their technology and infrastructure such that all of our providers were ready to provide telemedicine before COVID. So when COVID hit, we pretty seamlessly transitioned to telemedicine. So our revenue from peak to trough was only down less than 2%, and that excludes one of our companies, which is a telemedicine company, which was obviously growing very fast, so that skews the numbers. And from the pre-COVID levels to the middle of the summer, the portfolio is up close to 20% in terms of revenue. So again, excluding that one company. So I think from that, it helped investors see those differentiation factors. And, we hit our $200 million hard cap quickly, and we're both substantially oversubscribed, and really only had one group say no to us once we had got into the trough of COVID from there till when we closed the fund.
Wow, that's great. That's a lot of money coming to the market. So it sounds like you have a lot that you can invest in based upon what the bankers had to say. So Nick, I hear that HCAP just recently closed a pretty innovative deal in the healthcare IT space. Can you tell us a little bit about it and, why HCAP sees that this is going to be valuable and how, the last year impacted this deal?
Sure. Thanks for having me here, by the way. So press release actually went out today, so it's good timing. We invested in a company called 83 Bar based in Austin, Texas. They're essentially a patient activation platform that helps and retains qualified individuals for clinical trials and commercial treatments. They essentially locate patients on behalf of their clients and evaluates them using online screeners, and then activates those patients who are ready to act with the medical providers. During COVID, what we saw was that we've had prior experience working with some software companies that were related to patient recruitment and patient engagement. And we saw the interest from the CROs in the space, the clinical research organizations, and the large pharmas. This was a company that was a part of the value chain in helping identify patients for these clinical trials. But during COVID, what we saw was that there was a significant shift in how patients were recruited and engaged with given COVID. And so virtual trials were really starting to take off during 2020. And this company was already doing that ahead of time, but their ability to close deals, not only during Q1 and Q2 of last year when COVID really came on strong, but during Q4, we saw really good shift in how people are approaching this issue in the marketplace. So we really like what we were seeing with this company. They have a strong management team, really great operating performance. Their bookings growth last year was over 300%. They have strong operating metrics in terms of how their ability to click through and get customers is better than the industry averages. And then overall, just, the clinical trial space in general is just a hot and growing market that we don't see any slowdown. So all those things led us to make the investment in Q4 of last year.
Yeah, that's great. I think I even got invited to a clinical trial in the past few weeks that I would have probably never seen if it wasn't for, a tech-enabled company. So, to follow that, Mike kind of alluded to it earlier, the Mission Healthcare exit. What can you tell us that you learned from that about doing an exit during COVID?
Yeah, that was a fantastic exit for HCAP, Mission Healthcare Services. This is a home health and hospice provider located here in San Diego. A company with about 600 employees. We went into this investment in Q1 of 2019, so it was a relatively fast exit for us. But I think at the end of the day, we knew there was a lot of regulatory concerns around reimbursement, PDGM changes in the marketplace, and how providers were going to get impacted by the reimbursement rate and cash flows. This company was able to navigate the market under the leadership of their CEO, Paul Verhoeven, really well. They had best-in-class software. They had #1 market positions in a lot of locations in Southern California, and just a really good operating team on the sales and marketing and clinician side. During COVID, the company was really able to handle well the crisis that unfolded very quickly back in Q1 and Q2. They were able to, get PPE equipment, N95 masks, respirators, and have the ability to treat patients during the initial stages of COVID very effectively. And so that led them to continued growth in 2020. And, there was a lot of interest in the marketplace from strategics and private equity firms. And the company was ultimately bought by a private equity firm out of Chicago called Vistria. So it was really exciting to see that they were able to grow during COVID, but it takes the right leadership, the right platform, and the right infrastructure to get to that stage, to be able to sell in a market like what we're seeing.
Yeah, I'm hearing a theme of technology, which I may be bringing up in a second here, but Jay, I want to bring it to you. So being, one of the people that provides operational and financial leadership at many of Riata's platforms, you were really in the trenches for the past year, helping out some of those companies, specifically in the physician clinic space, which had to face those stay-at-home orders. So can you tell us a little bit about managing during COVID and how you think that has changed or almost improved your business on the go forward? You're on mute, Jay.
Can you hear me okay?
Yes, there you go. Thank you.
All right, sorry about that. Thank you. Thanks for having me here on the panel. Yeah, no, it's certainly, as I think everybody experienced it, this whole world of COVID changed the world on everyone's world on its head. And I think, for our focus, first off and foremost, when I jumped in with the Acuity Eye Care Group, AEG Vision, the first focus on it was really trying to be proactive. I come from a restructuring background. I had done some work with Alvarez and Marcel and really put the restructuring hat on to figure out how to kind of navigate the waters up front. So first thing and foremost for us was kind of cash management, making sure that we had enough of a runway to go as far as what, at that point in time, nobody knew how long this was going to take effect of really shutting down your business. So just being as conservative as possible with our cash, working with our vendors. And then it was, I think the next big step was kind of educating our investors, both our lenders and our investors themselves, the equity behind it, and them to know the situation. We weren't in crisis mode when it happened. So it's really kind of giving them assurances of, we've got a runway in place, but we were certainly looking for their support. Inevitably, there's going to be some burn of capital that was going to take place. As we kind of, had to shut down the business, as you mentioned, the mandatory stay at home was in place there in April. That gave the business itself, the operations teams, to really kind of focus and reboot on how we want to approach the business going forward, how we need to change the model itself. So as the team itself was developing those strategies and those ideas, we're really working on the key pieces of, what are the two things you need. First off, as someone mentioned, you need to get qualified as an essential service. I think that's really key for us to make sure that we can open the doors and serve a patient and proceed in that manner. The second piece was providing a safe environment, not just for the patients themselves, but also for all the employees, making sure that the doctors and their staff all knew that we were focused on making sure there was a safe environment for everyone to walk into the practice and have the service that they intended to receive. So we moved along on those ends of things. And I think as you do reopen, the biggest piece then was creating credibility of performance. And for the first 2 or 3 months, as we were getting the business back up and online, it was really kind of driving that improvement in performance. And the model changed because we had to shift from where patients were proactively coming to the practice. We really focused on a pull model, really focused more on opening up our call center and bringing patients in and filling the books, because you can't rely on a walk-in to go ahead and drive your revenue on a given basis. It was really pulling those patients into the practice. As we started to build that credibility, we started to kind of deliver that performance. That was our time to really then start working with our lenders and with our investors to put some capital behind us to make sure that we had enough on the balance sheet to navigate us through Q3 and Q4. And where I work, it's a platform buy and build. Our focus has been growth. So once we stabilized the core operation, the real focus for us was trying to convince our investors that it's time for us to go ahead and start buying. And we successfully bought another 50 practices in the second half of the year to kind of basically increase our size of another 30 or 35%.
Wow, so that's truly that valley followed very, very steep peaks. So that's great to hear.
Yes.
I want to jump to reimbursement again here. Obviously it's complex. We talked about it previously, but Grant, it sounds like you guys are doing some pretty innovative things at Council Capital by working with entrepreneurs. Can you kind of talk to us about the way your panel of experts and value creation team helps you all navigate this landscape that's changing every day, honestly?
Yes, happy to. And a little bit of context. We're very entrepreneur friendly and growth oriented. And to do that, you really need to be pretty flexible in terms of how we invest. So we, use capital to buy other companies, a recap, fund growth, really any permutations are possible. And we show the entrepreneur, here are some resources we can bring to bear to help you grow and scale your business. So that's a very founder-friendly, management team-friendly way to support them in terms of their growth, rather than just giving them a template. We're trying to understand their vision and then giving them an array of tools that they can draw on. So what those are, we have 34 CEO council members. Those are mostly current and former healthcare CEOs, generally of very large companies that have scaled a lot, plus former government officials. And then we also have, and by the way, they've invested over $140 million of their personal, their personal money into our funds. So when we invest in a company, they are directly invested with us, which really changes their approach to helping the companies. And then we have a value creation team that can help with a variety of things, such as recruiting for senior level hires, or helping with how to recruit and retain more caregivers. They can help with strategy and a variety of other ways. And so as it relates to reimbursement, on our CEO council, we have the former head of CMS, the former president of the National Medicaid Directors Association, former vice president of the National Medicaid Directors Association. And so because they have significant amounts of their net worth tied up in council, they're motivated to ensure we assess reimbursement risk well and pick the right sectors and states to do business in. So we use that both to find and evaluate businesses, but then when we invest behind an entrepreneur, the entrepreneur then has those same resources supporting them, because each CEO council member is invested directly through the fund into each company. And so we feel that gives us an edge as it relates to reimbursement risk. And that's really what drove us into focusing on what have turned out to be essential services, because those services tend to be the ones that we felt had less reimbursement risk to begin with.
Right, that's awesome. So I want to take a quick shift and move to the tech space. So obviously you can both invest in tech companies, or there's also the pivot of investing in the value of technology within your portfolios and platforms themselves. So Nick, can you take a little bit of time talking about investing, in IT companies? Many of us are used to seeing revenue cycle companies or revenue cycle systems, but can you tell us a little bit about what HCAP expects to see in any new innovative healthcare IT models?
Sure. Yeah, I mean, I think you saw it in 2020 with the issues related around COVID and the move to telehealth. That's an obvious move in the marketplace to health. What we're seeing is, everything in terms of closing deals and IT related deals is shifting kind of to a virtual model. Obviously with 83 Bar new investment, their ability to close deals and provide virtual services in the clinical trial space is something that we found very attractive. But I think, across the supply chain, where are companies able to help existing providers in the marketplace become more effective, not only in their traditional format, but more in a virtual style format? We have a portfolio company right now called Sleep Data, and they have a platform company called Better Night. And this really is able to provide patients with virtual sleep assessments related to sleep apnea. And so that you can get assessed and see if you have sleep apnea, and you can send it over to Better Night and they can assess it virtually. So those are some sectors that really we think are exciting. Obviously, 83 Bar, we have a enterprise software company called TCS that focuses on population health and managed care software. They're really focused on working with third-party administrators and health plans to focus on case management and program intervention. So there's a lot of different areas in the healthcare IT sector that we like, and based on a lot of the research that we've seen coming out, this place is only accelerating. And so we really like the space a lot, and we'll continue to focus on this sector going forward.
Yeah. So Jay, I'll put this on you, with closing 50 deals in the second half of the year, I can't imagine the integration issues that you guys have to deal with. How has investing in IT within your platform itself been pivotal to success of that platform?
No, it's the whole key. I mean, it's people, process, and the platform is IT. I mean, we're buying entrepreneurial type practices, single-owned, doctor-owned operations, and they don't have that technology in place. They don't have the value and really the platform that we're going to bring to them. I think first and foremost, it's key is to have a CIO who has that business acumen behind it. We really rely heavily on the CIO in terms of he gets it. He understands the key elements of the data that's running through on the operating or ERP system and how that interfaces with your financials and your operating performances. But to take it even broader, in our space, we don't have a lot of software that's ready to grab off the market and drop on the shelf. I mean, certainly our POS system, our billing system is certainly one that you get, tailored to the vision space, but even that has a lot of pitfalls and issues. So a lot of our technology has to be done proprietarily, be done in-house. But it ultimately becomes a key value proposition of what enables us to really drive this growth model, because we're taking all these little modified single operation type businesses and streamline them and bringing them into our AEG umbrella, our AEG platform. And that is the value. I mean, we're taking, 130 practices at the end of the year, last year, 180 today. We're taking all that visibility today and bringing it all together where we can manage it from afar, break it down by practice, and really understand what's being done. I mean, we wouldn't have the performance improvement, whether it's top line revenue growth, cost of goods sold management, or four-wall P&L without what technology brings to us. It helps on all facets.
Yeah. So it sounds like obviously when you're starting to, technology seems to be the front of any industry at this point. So it's something pivotal for sure in the healthcare space as well. So we ran out of time as we thought again. And, I'm seeing lots of questions that are popping up in the Q&A, but it goes without saying, thank you all so much for being part of this. We really appreciate your time and your insights. It's an exciting place to be in healthcare private equity. So at this time, I'm going to turn it over to Tatiana. Thanks.
Thank you, Kayla. Great job moderating the panels. And thank you to all of the panelists. Thank you, guys. At this time, we would like to open it up for questions. It looks like we have a good number of questions. Scott Ellison will be handling this part of the program, and I'll introduce Scott real quick. He is the founder and principal of Clarity Performance Partners. They're based in Austin, Texas. And Clarity is a management consulting firm that provides strategic consulting, executive coaching, outsourced executive management, corporate development, and process improvement services to growing healthcare clients across the country. Scott has served in C-suite executive and strategic consulting roles for a number of private equity-backed organizations in the skilled nursing, home health and hospice, physician practice management, managed care, and technology industries. I saw some questions about SPACs, and guess what? Scott is also the president and CEO of EQ Health Acquisition Corp., a blank check or SPAC company formed to invest in the healthcare services sector in partnership with FS Investments, a $23 billion alternative asset manager. Prior to founding Clarity and EQ, Scott was the CFO of Hardin Healthcare, growing the organization from $150 million of revenue to almost $1 billion. Scott?
Thank you, Tatiana. Certainly glad to be with everyone today. Well, we've got a lot of questions, and we've got all of our panelists here. So we're going to, while there were a couple specific questions about SPACs, the first question that I'd like our panelists to speak to is if you kind of back up off that a little bit and think more broadly about financing. There was obviously various things that affected getting deals financed during 2020, including the pandemic and everything else. As you look at where we are today and you look forward as we get further into 2021 and post, what are various, what's your sense as to the state of the current financing market, and how do things like SPACs potentially impact those? Whoever would like to start, feel free to talk a little bit about, and also too, if you could be specific on your space, because I do think that it matters. There's obviously different things to consider in each of the spaces.
Maybe I can start from a healthcare services perspective. Within the Raymond James healthcare banking practice, we've seen, kind of like everyone else, just the explosion of SPACs over the past year or so. And it's a topic of discussion with each client. I think when we outline and map out a process of what we want to do to achieve our clients' goals, it becomes part of that discussion. I think over the last 5 or 10 years, healthcare services companies have really focused on partnering with private equity firms and staying private for a really long time, and kind of moving up the chain of private equity firms in terms of size, and haven't been going public maybe like you've seen in other sectors. But I think SPACs provide an interesting way to do that. We've seen Talkspace going public via SPAC recently at a north of $1 billion valuation. That's really exciting. Again, it plays on a lot of the COVID trends around mental health and those tailwinds. Primary care is starting to see some activity from an equity capital markets perspective and a SPAC perspective as well. We haven't specifically worked on a SPAC deal yet. It's been we've had discussions, we just haven't gotten there yet. So it's intriguing. I think from our perspective, it's still in that TBD phase of what it's going to look like over the short to intermediate term. So while we've had good discussions, haven't gotten there yet. I think from a broader financing standpoint, we had in the middle of 2020 questions around the debt market. I think from the deals we worked on, financing ended up not becoming an issue. We always tell our clients that rolling equity into the new deal with a new sponsor always sends a good signal, because it shows that your new partner that you're bullish on the business. I think that's now more important than ever, to really show that you're standing behind the business, you're standing behind the outlook and the projections that you've been talking about during a process. But if you, the seller, put your money where your mouth is and roll equity, it makes the deal easier to finance, but it also really creates that partnership with your private equity firm. So, coming at it from a couple different perspectives, but that's how we've seen the market evolving over the past, call it 12 months.
Absolutely. And guys, as you think a little bit more about financing, how does that translate into the prices being paid for businesses? I mean, I think everyone, you look at some of the big, maybe non-healthcare SPAC deals, and you get these crazy multiples of 2025 pro forma adjusted 1 month annualized revenue, and it's not healthcare services, right? But how are you thinking about not only SPACs, but also lenders' willingness to stretch on deals? How does Mez fit in? And at the end of the day, what are you guys seeing in your spaces from a pricing perspective, specifically anything being influenced by financing?
Yeah, I mean, I can jump in here first real quick.
Yeah, please.
I think from a Mez perspective, historically, you've seen total debt to EBITDA ratios of 4, maybe 5 times, but I think given COVID, a lot of people got tighter on the covenants. Maybe they want to see 3 times out the gate on lower middle market deals, companies 10 to 100 million. So I think it just depends on which market you're playing in. You can still get the high multiples, but ultimately the amount of financing you're going to get is dictated by kind of these leverage covenants that you're seeing in the marketplace. But I think people are being a little bit more conservative.
Right. Are you guys seeing a trend away from the covenant light? Are you guys clearly seeing lenders being a little bit more definitive about reporting requirements? Becky?
I think so. I think that the other trend that we're really seeing is, what is that EBITDA that you're able to leverage? I think if you go back, a year ago, you were getting a lot more credit on your add backs. I think lenders were being a little bit more aggressive on the difference between cash EBITDA and an adjusted EBITDA number. So that adjusted EBITDA number could be a little bit larger. I think there are some lenders who have, maybe gotten burned on that, where some of those add backs and some of those adjustments haven't necessarily come to fruition. And so lenders are being a little bit more strict on what is EBITDA that they're leveraging. I think, access to debt capital clearly impacts valuation when you look at from a private equity standpoint. Either being able to put more debt or having a higher growth rates are some of the easiest ways to juice up your returns and be able to afford that higher price. I think the debt market was definitely unstable and uncertain in Q2 and in the summer, which is part of the reason, a big part of the reason too, why you weren't seeing deal activity. It seems like that, debt capital is definitely available now, and it's part of the reason there's, plenty of capital out there to help fund this activity that we're seeing.
Absolutely.
And I'd say from a private equity standpoint, so, the bankers are happy as long as there's a lot of activity, right? And
Right.
when prices are high, and there's a lot of activity, that's awesome. If you're sitting in private equity shoes, you've got to own a business and you've got to think through what the next cycle is. The challenge we have is that with all of the stimulus money being pumped into economies around the world, it's hard for us to see when the party ends. So it's not like the cycles we've seen before, where you would get to a certain amount of stimulus and then something would pop. So what we've had to get comfortable with is we sort of think of ourselves similar to if you're a retail investor, you dollar cost average into something because you can't timing. We just have to steadily invest, recognizing that right now things are really priced for perfection. And so when things turn, mean bad things for those investments. But if you're out of the market too long, then that causes potentially as big of a problem, because you can't really tell when the end of the cycle is going to happen. So I think if you're an entrepreneur and you understand that, for an entrepreneur, you've got one company. For private equity, we at least have a portfolio. But if you've got one company, the cycle is a whole lot more for you. So you can take advantage of the fact that private equity funds and other buyers have to be putting money to work. And that means you can get out at very high multiples, and not only multiples, but at EBITDA numbers that are somewhat, let's just say, prettied up.
Right. Guys, thank you for that. I know we could talk about financing I think we've got a couple of minutes left. There were a couple different questions asked. One was from Tatiana. Could you please comment on the impact of Walmart Health opening clinics across the country on healthcare services delivery, and what market participants think about Walmart's expansion into healthcare? There was another similar question from Christine Bryant. She said, very similar question from me, but she's wondering about the impact of Amazon potentially becoming part of traditional healthcare. Would you guys mind commenting on just, these big new market entrants? Also, too, if somebody wanted to comment on any impact one way or the other of the Biden administration, maybe we can get a little bit of a color kind of across the board as we think about where we are now, new market entrants, or sizable potential market entrants, and also to any kind of administrative change that you think folks should be looking at as the Biden administration comes in. Whoever wants to start.
Just starting with some of those interesting new entrants coming into the market, I think one of the big things with healthcare is really complicated, and I think different aspects of it can have different levels of complication. When you think about Amazon, Amazon, Berkshire Hathaway, and JP Morgan had a healthcare venture recently announced is actually being wound in February of 2021. I think this is a perfect example of people who are really good at what they do, but thinking if they're good at what they do, they can be really good at healthcare and not understanding all the nuances of healthcare. And so, I think having those sorts of entrants, is not really a threat to the market. When you think about, Walmart having clinics, this would be pretty similar to like the little clinic, or where you see urgent care type clinics popping up in grocery stores and things. I think that's a really helpful aspect just from a patient standpoint, especially if they're serving markets that are underserved. I think there's definitely a need for, healthcare in some of those more rural areas. And if Walmart finds a way to do it, great. I think they're never going to be able to provide specialty services through Walmart. Nobody's going to go to Walmart to meet with a urologic surgeon to talk about the next surgery that they're having. So there will always be a need for specialty healthcare services, kind of across the board, but it's more of just getting that clinic aspect out there.
Great. Yeah. And I'd comment broadly on non-healthcare market entrants. Yeah, they've always been people coming into healthcare from the outside, and generally they haven't done well. But I think that historically that's because healthcare wasn't ready to change much at all. It's still changing slowly, but as it is evolving into a more of a consumer-oriented, with more of a consumer orientation, it starts to play into the strengths of some of the non-healthcare players. So I think we will see success from some of them, and then there'll be, significant failures from others. It's very hard to, for me, as we look at it, it's very hard to tell where the successes and the failures will be. But I do think the successes are generally going to be more aligned with where, particularly the big tech companies are well positioned relative to, where the historically strong elements of healthcare providers, payers, et cetera, have been. So, at least the way we think about it is we look at all these different sectors in healthcare and say, where are there threats that we think are legitimate? And generally we try to avoid them. Not a hard and fast rule, but it's generally how we think about it.
Got it. Tatiana, how are we doing on time? Are we right at, or do we need to start the breakout sessions yet? Do we know? I'm sorry, Tatiana, I think you're on mute. There you go.
I think we need to wrap up. Thank you guys so much. Scott, thank you for leading this part of our presentation. Thank you to all the panelists for your feedback. I'm going to name the panelists once again so you guys remember them. David Cream, Becky Gregg, Mike Malloy for the investment bank panel, Jay Bradford, Grant Jackson, and Nicholas Lopez for the private equity panel. And of course, a huge thank you to Kayla Marsh for moderating our panel. And